Imagine a clock that, doesn't just tick, but literally forces billions of dollars to change hands every single time the second hand moves.
Yeah, and not just change hands, but physically break the stock market on a random Friday afternoon.
Exactly. Welcome to this deep dive. For you listening right now, our mission today is to demystify one of the most powerful, kind of invisible forces in the market, option theta.
Or, as the quants call it, the mathematical pricing of time.
Right, the pricing of time. And we're looking at a massive stack of highly technical quant research for this, covering everything from the theoretical Black-Scholes framework all the way down to the market microstructure dynamics that cause those wild intraday market swings we always see.
It is such a fascinating stack of sources because it proves that the old cliche, time is money, it's not a metaphor here. It is literally a math equation. But in the options market, time doesn't tick continuously on a clock. It stretches, it accelerates, and it behaves almost like a physical force, one that forces market makers into executing enormous market-moving trades, whether they want to or not.
Wow. Okay, so before we get to how time decay can cause a stock to go completely haywire right before the closing bell, we need to define the engine driving this whole system. We need to look at what theta actually is in the real world.
Right. So at its core, financial derivatives like options are modeled as wasting assets.
Wasting assets, meaning they just rot away.
Basically, yeah. Their theoretical value relies incredibly heavily on the passage of time. Theta is simply the Greek letter quants use to quantify that specific sensitivity.
So it's basically measuring the decay.
Exactly. If we look at it mathematically, it's the first-order partial derivative of the option's value with respect to time. And because time only moves in one direction, forward, options constantly lose their extrinsic value as they approach expiration.
Assuming the stock price and the implied volatility stay perfectly flat, your option just bleeds a little bit of value every single day.
Yeah, that's the baseline expectation.
But the research points out that this math combines volatility-induced time decay with carry costs, like dividends and interest rates. And there was this bizarre anomaly in the data that just, well, it stopped me in my tracks.
Oh, I think I know what you're going to say.
Yeah, theta isn't strictly a negative number for an option buyer. There is a very specific scenario where put theta can actually turn positive.
That is easily one of my favorite quirks in the mathematics of options. It's so counterintuitive.
It really is.
But it only happens in very restrictive situations. You need a deep-in-the-money European put option on a stock with a positive interest rate and zero dividend yield.
Okay, let's unpack this. Because a European put option can only be exercised at expiration, right? Not early.
Right, exactly. Only at expiration.
So if you're holding it and it's deeply in the money, you essentially have a guaranteed cash payout just waiting for you in the future.
Yes, and that guaranteed future cash payout is the key. Because remember, we're operating in an environment with positive interest rates.
Right.
And the fundamental rule of finance is that money today is worth more than money tomorrow. So as time passes and you get closer to that payout date, the present value of receiving that guaranteed cash actually increases.
So the interest rate carry cost effect gets so strong that it, overpowers the time decay?
It completely overpowers the negligible time decay of the option itself.
Yeah.
So you end up with a positive theta. The option literally goes in value just because the sun came up.
That is wild. But, for the vast majority of trades, buying an option means dealing with negative theta, which leads me to this avocado analogy.
Well, the avocado analogy, let's hear it.
Well, buying a standard option is like buying a rotting avocado. Every day it sits on your counter, it loses value, it gets a little more mushy.
Yeah.
So if holding an option is guaranteed to bleed money every single day, why on earth would anyone ever buy one instead of just selling them to collect that daily decay?
That is the perfect question.
Yeah.
And the answer is because of what we might call the law of conservation of financial energy.
Sounds intense.
It is. In options trading, you pay theta to buy gamma. You cannot escape the Black-Scholes partial differential equation.
So it's a structural trade-off.
Exactly. If we assume a frictionless market and a zero risk-free interest rate, just to strip the math down to its absolute bones, there is a strict, inescapable inverse relationship.
Okay, how does the actual equation enforce that, though?
Well, the formula dictates that theta equals -1/2 times volatility squared times the asset price squared times gamma.
-1/2 times all those squares.
Right, and any squared number is mathematically guaranteed to be positive. And gamma itself is mathematically guaranteed to be positive for any long option position.
Oh, I see. So if you multiply a negative by a positive, by a positive, by a positive, the result absolutely has to be negative.
Bingo. Theta has to be negative. It's a structural seesaw. The buyer of an option pays negative theta as, like, rent to hold a positive gamma position.
And gamma is the explosive part, right?
Yeah, that positive gamma is your lottery ticket. If the stock price moves violently, your profits grow exponentially. You're accepting a guaranteed linear daily loss for the chance at an explosive nonlinear payout. The universe just prevents you from getting infinite free money, so you have to pay a tax for that convexity.
And the seller is obviously taking the other side of that deal.
Always.
So they get to harvest that positive theta as daily cash income. It just hits their account. But in exchange, they absorb the negative gamma risk.
Yes, and if there is a massive directional move in the stock, their losses accelerate exponentially.
So it's not just picking up pennies in front of a steamroller. It's more like selling earthquake insurance. You collect tiny, steady, incredibly reliable premiums every single month. You feel like an absolute genius until the tectonic plates suddenly shift, and then you owe billions.
That's exactly it. And the institutional quantitative desks are fully aware of this tectonic risk. For complex derivatives where simple equations like black skulls fail to capture reality, they rely on advanced numerical methods.
Like the finite difference method, right? The FDM. I read about this in the sources, but honestly, it felt incredibly abstract.
What's fascinating here is how the quants literally map this duality out on grid nodes.
But how do they actually visualize the spatial curvature? Because I'm trying to picture a spreadsheet and it's not working.
Don't picture a spreadsheet. Picture a three-dimensional topographical map, like a huge landscape of mountains and valleys.
Okay, I have the landscape.
The x-axis going across is your time to expiration. The y-axis represents the underlying asset's price, and the elevation, the actual height of the mountains and valleys at any given point, that's the theoretical value of the option.
Okay, that makes sense. Where do the Greeks fit into this 3D map?
Delta is the slope of the hill you are physically standing on. Gamma is the curvature of the valley, so how sharply that slope changes as you take a single step.
And theta?
Theta acts as the gravitational pull on the entire landscape. Through this FDM grid, theta is the temporal stepping mechanism. As time moves forward along that x-axis, gravity pulls the elevation down. Yeah, so the quants use this 3D map to balance the directional drift against that spatial curvature, ensuring their exposure is hedged at every discrete coordinate on the grid.
That makes so much more sense now. Time is literally the gravity pulling the option's value down. But time doesn't decay in a straight line, right? Depending on the option's moneyness, time can suddenly hit the accelerator.
Very much so. Theta decay is highly nonlinear, and the mathematical culprit is the presence of the square root of time in the denominator of the black skull's formula.
The square root of time.
Yeah. As time shrinks, as that denominator gets closer and closer to zero, the absolute value of theta expands at just a staggering rate.
And the empirical data in the sources is shocking when you look at the money options. They have the maximum extrinsic value because they have the maximum uncertainty.
Precisely.
The data shows an at-the-money option at 60 days to expiration has a daily theta of negative 0.0338. But then, half a day before expiration, it explodes to negative 0.302.
Which is a nearly 9-fold increase in the speed of decay.
Ninefold. It looks like a hockey stick on a chart. It reminds me of, well, a burning fuse attached to a stick of dynamite.
I like that.
Right? Because when the fuse is long, it burns at a steady, manageable rate. You aren't really sweating it. But as that spark gets inches away from the explosive, the heat intensifies, the spark seems to jump faster, and the urgency just skyrockets.
And that surge in time decay is perfectly mirrored by a massive surge in gamma risk.
But the profile looks entirely different for out-of-the-money options, doesn't it?
Completely different. Deep out-of-the-money options consist entirely of extrinsic value. So right before expiration, the probability of them ever actually paying out is effectively zero.
So what happens to the decay?
In absolute dollar terms, their theta decays to zero. There is simply no dollar value left to erode. It hits a daily theta of 0.00.
Here's where it gets really interesting, though, because this is a massive psychological trap for retail investors.
Oh, absolutely.
Someone looking at their brokerage app on their phone sees a cheap, short-dated, out-of-the-money option for like 5 cents. They think the absolute dollar decay is tiny, so they assume the risk is low.
But the percentage decay rate is what destroys them.
Exactly.
If you buy that option for 5 cents and it loses just 1 single penny a day to theta, you aren't just losing a penny. You are losing 20% of your total remaining capital every single day.
20%. Any delay in the stock making a favorable move completely wipes out the entire position. The math simply does not care about your thesis.
It really doesn't.
And if decay is this aggressive during regular market hours, what happens when the physical market closes? The friction between these theoretical continuous time models and the reality of a Friday afternoon is just fascinating.
You were talking about the classic day count convention problem. Quants have to translate a physical, real-world calendar into a mathematical fraction that a computer can actually process.
And there are a few ways they do this, right?
Yeah, three primary models. First is the 365-day calendar model. This one assumes time decay is continuous and uniform across every single day of the year, including weekends and holidays.
So under that specific model, the weekend from Fridays close to Mondays open represents 3 full days of decay.
Correct. Then you have the 251-day business model. This one assumes time literally stops on weekends. It treats a weekend as if only one business day has passed.
Which feels a little too simplistic.
It is. So finally, there is the 308-day blended model. This attempts to split the difference by weighting weekends at 0.5 times a normal business day. It acknowledges that geopolitical news or, macroeconomic events can happen over the weekend, but obviously trading volume is lower than a standard Tuesday.
But a huge portion of legacy software still uses that 365-day model.
Yes, it does.
And that creates a mathematical artifact called the weekend effect, because the real-world market doesn't actually decay option prices by a full 3 days over the weekend.
Right, because the physical market is closed. No one is actively trading.
So when Monday morning rolls around, the actual market prices look significantly higher than the 365-day model predicted they would be.
The model expected a massive 3-day price erosion, but the market only delivered roughly a day and a half of actual decay. So to reconcile this discrepancy and stop the software from just throwing error codes left and right, the pricing models artificially spike Monday's implied volatility to bridge the gap.
Wait, so to stop risk-free arbitrage, floor traders must be doing something on Friday, right? Because if the model expects 3 days of decay, why can't a trader just short sell options on Friday at 3:55 p.m., go enjoy a barbecue on Sunday, and then buy them back on Monday morning to pocket 3 days of free time decay?
It sounds like free money, right?
It totally does.
But market makers aren't naive. They employ active defensive pricing to eliminate that exact arbitrage. As Friday afternoon approaches, market makers systematically compress the implied volatility of the options across the board.
Oh, wow.
Yeah, they're artificially bleeding the premium to price in the expected weekend decay before the closing bell even rings. If you attempt to sell on Friday afternoon, you're already getting a suppressed, weekend-adjusted price.
So floor traders literally have a manual mathematical formula to alter Friday prices, calculate undecayed weekend time, and reset Monday's baseline.
They do. Traders using the 365-day models calculate what is called the decay shortfall.
Decay shortfall.
Yeah, which is the difference between the model's theoretical 3-day decay and the empirical reality of the weekend. Historically, about 1/3 of the expected weekend theta is left undecayed.
Okay.
So they take that specific shortfall amount, divide it by the option's vega, which is its sensitivity to volatility, and manually add that resulting number back into the volatility input.
That is insane.
That manual hack creates the new unchanged baseline for Monday morning. Without that human intervention, the automated systems would trigger false volatility alerts all morning.
The friction of the real world literally forces human beings to manually override pristine mathematical equations. That's incredible.
It is.
And because market makers actively defend against simple tricks like those weekend holds, sophisticated traders had to evolve, right? They started using multi-leg structures to weaponize the term structure itself.
Which brings us to the calendar spread.
Right.
You sell a short-dated front-month option and simultaneously buy a longer-dated back-month option at the exact same strike price.
And traditional options education pitches this as a simple positive theta strategy. Like the short-dated option decays faster, so you just collect the spread, but the quant sources completely tear that apart. They say it is a massive oversimplification.
If we connect this to the bigger picture, standard education completely ignores the volatility dimension.
Yeah.
The calendar spread is not just a theta play. It is actually a net long vega play on forward volatility.
Okay, but why is the back month option so much more sensitive to volatility changes than the front month?
Because there is simply more time for a volatility shock to materialize. Vega measures how much an option's price changes for every 1% move in implied volatility. The longer the time to expiration, the higher the vega.
Makes sense.
So if you are buying a 90-day option and selling a 15-day option, you are heavily long Vega. Institutional traders using calendar spreads aren't really making a directional bet on the stock price. They are trading the differential in time and volatility expectations between those two dates.
Let's compare that to a vertical spread, just for context, where you buy and sell different strikes in the exact same expiration cycle. A vertical spread is net short Vega. You want the underlying price to hit your target, and you generally want implied volatility to drop.
Right.
But if implied volatility collapses across the board while you are holding a calendar spread, which traders call IV crush, you are in deep trouble. Severe trouble. The long back month option will lose massive amounts of value from that volatility drop because of its high Vega, and those Vega losses will instantly overwhelm the few pennies of positive theta you collected from the short front month option.
So to protect against IV crush, traders look at metrics like the volatility risk premium Z-score, right?
Yes.
They want to see a VRP Z-score above 1.0 before entering a calendar spread. That tells them the back month premium is historically rich and provides a statistically favorable cushion.
Exactly.
But here's the structural pivot. Traders eventually got tired of getting wiped out by IV crush on these long-term structural trades. The market always seeks instant gratification.
Always.
Because long-term spreads are so vulnerable to volatility shocks, traders started compressing the timeline. They abandoned the back month entirely. And that brings us to the absolute chaos of the zero DTE revolution. 0 days to expiration. Zero DPE has fundamentally altered equity market microstructure. It compresses the entire life cycle of an option, months of pricing dynamics, gamma exposure, and theta decay into a single trading session.
Remember that burning fuse metaphor from earlier?
Yeah.
With zero DTE, you are holding the dynamite the moment you buy the option. During the morning, the decay is aggressive but fairly stable. But by 2:00 p.m. Eastern Time, the hourly decay rate roughly doubles.
And by 3:30 p.m.
It is moving 4 to 5 times faster than morning speeds. It is a complete temporal death spiral.
And this insanely compressed time frame leads to a mechanical market phenomenon called pinning.
Pinning. Let's talk about that.
Well, market makers are the liquidity providers of last resort. When retail and institutional traders flood into zero DTE calls and puts, the market makers are the ones selling them. They end up holding massive, firm-threatening inventories of short option contracts.
Which they have to hedge.
Right. To survive, they have to dynamically delta hedge their directional risk by buying and selling shares of the underlying stock to stay neutral.
The sources outline a formula market makers use called a pin score. It evaluates different strike prices to see which one will act like a magnet. But how does that magnet effect actually work mechanically?
Let's walk through it. Imagine a stock is trading at $101, and there is massive open interest in the $100 strike zero DTE options.
Okay, I'm with you.
The market maker is short those options. If the stock starts drifting down toward $100, the delta of those options changes rapidly. To stay neutral, the market maker is forced to buy shares of the underlying stock.
And that physical buying pressure from the market maker stops the stock from falling any further. It essentially props the price up.
Exactly. But what if the stock bounces and starts heading up to $102? The delta shifts the other way. The market maker now has too much long exposure from their stock hedges, so they are forced to sell shares to flatten their book.
And that selling pressure pushes the stock back down.
Yes. That dynamic delta hedging creates a physical ceiling and a floor. As the clock ticks closer to 4:00 p.m., the gamma explodes, making the market maker's hedges even more sensitive. They are buying every dip and selling every rip with increasing size.
Wow.
This mechanical buying and selling physically pulls the stock price directly toward that $100 strike. They literally pin the stock to the strike price as the bell rings.
The math literally dictates the market structure. But what happens if the pinning fails? What happens to market stability then? The researchers introduce a concept called the gamma theta break-in range, or GTBR.
The GTBR is the critical survival threshold for market makers. As long as the stock price stays inside this defined boundary, the steady stream of positive cash flow they generate from that hyper-fast zero DTE theta decay is enough to cover the small losses they take from having to constantly buy high and sell low to stay delta hedged.
So their book remains profitable.
Exactly, their book remains profitable.
So what does this all mean? I picture it like a massive hydroelectric dam holding back a reservoir of water.
Okay, another analogy, let's hear it.
As long as the water, which represents the stock price, stays below the GTBR line, the dam functions perfectly. The water turns the turbines, generating a steady, powerful stream of electricity, which is their theta profit. the whole ecosystem is balanced.
But if an exogenous shock, a sudden macroeconomic data release or a massive institutional order pushes the underlying asset price completely outside the GTBR.
The dam is breached.
Exactly. The cumulative gamma losses instantly exceed the theta profits. Their net P&L turns violently negative.
And when the dam breaks, their hedging demand changes from elastic to completely inelastic.
They have no choice.
Right. To prevent exponential, firm-destroying losses, they are contractually obligated to hedge their exposure at absolutely any available market price. They flood the entire market, buying or selling wildly, draining all available liquidity, and causing a massive, violent intraday market crash or spike.
The time decay forces their hand. They aren't making a conscious choice to move the market. The Black-Scholes equation is essentially executing a margin call on their inventory.
Wow. We have journeyed all the way from the theoretical constraints of the gamma-theta duality, visualizing the spatial curvature of that FDM grid, down to the real-world friction of floor traders manually hacking the weekend effect.
It's a lot to take in.
It is. And finally, we've seen how the explosive, nonlinear nature of zero DTE hedging can literally crash a stock in the final 30 minutes of the trading day. Time is clearly not just a passive clock in the financial system. It is an active, tradable force that dictates liquidity.
It is the architectural foundation of volatility itself.
So for you listening, the next time you see the market gap up inexplicably on a Monday morning, or you watch a stock go completely haywire at 3:45 p.m. on a Friday, well, you will know it is not just random news or chaotic trading.
Yep.
You are watching the mechanical, inescapable math of time decay forcing the hands of the biggest players in the world.
Which leaves us with a really fascinating structural question about the future of global finance. We saw how much manual intervention and defensive pricing is required to manage time decay over a simple 2-day weekend.
Right. If the friction of market closures causes so much structural risk, what happens when global equity markets inevitably transition to 24/7 trading?
That is the big question.
If the market never closes, does the weekend effect completely disappear? Or does the spatial curvature of that FDM grid warp again, mutating the physics of financial time into something entirely new, something for you to mull over? Just remember, the next time you hear a clock tick in the options market, that tick isn't just a sound, it's a price tag.